Hi, everybody. This is the first of two programs we're going to do on financial regulation, a major preoccupation of Western governments in general and the Obama administration in particular. And though there is plenty of blame to go around, as we've learned through our coverage of these events over the past 2 years, we would like to focus tonight on just two institutions, governments and the banks. So, to do that, joining us now on the debate for the full hour in Sarasota, Florida, William Isaac, chairman of LECG, Global Financial Services, and author of Senseless Panic, How Washington Failed America. In Halifax, Nova Scotia, Tim O'Neill, former chief economist of the Bank of Montreal, now president of O'Neill Strategic Economics. In New York, New York, Yves Smith, author of Econ, How Unenlightened Self-Interest Undermined Democracy and Corrupted Capitalism. She's also the creator of the blog Naked Capitalism. And in Kingston, Ontario, Louis Gagnon, professor at the Queen's School of Business. Good of everybody to join us in the United States and in points beyond here in our country as well. I want to get started with this. I know there's lots of blame to go around, but I want, if I can, to get you to focus. And Bill Isaac, why don't I start with you? Who or what, in your view, was the main villain of the subprime mortgage-related financial crisis? Wall Street greed or bad government policy? If you had to pick one of the two, which would it be? Bill, that's for you first. Okay, I guess we've got some trouble there with Bill. Why don't I go to Tim O'Neill? Tim, you want to give that a try?
Well, I think of the two, it would be almost a coin toss, but I think probably on balance it would have to be bad policy rather than bad banks. Certainly banks, a number of them made mistakes, but it wasn't universally the case. We had some really egregious government policy mistakes, I think, both in encouraging the housing market bubble to get larger and larger. We had the Federal Reserve keeping interest rates too low for too long. So if you look at those two combined forces, the fact that we had a housing market bubble was hardly shocking. The aftermath of it was certainly significantly influenced by bad policy decisions.
Yves Smith, how about you?
I tend to lean towards blaming the Wall Street firms, although I don't think that blame is the most helpful construct in terms of moving forward. It's useful for a diagnostic standpoint. The subprime crisis would have been contained and would not have been a systemic crisis had it not been for the ways that Wall Street firms created synthetic products that multiplied the level of exposure well beyond that of what took place in the real economy. For example, the BBB tranches of subprime bonds, there were literally 10 times the value of credit default swaps written on those. And many of those exposures ultimately wound up at the banks themselves or at insurers like AIG that were highly leveraged and in no position to take large losses that ultimately resulted.
Louis Gagnon?
Well, Steve, we can blame the farmer for not locking the door of the hen house, but surely the foxes who get in there and actually take advantage of the situation have got to carry most of the blame. Wall Street has engaged in a massive scheme that lasted over several years. It was an incredible arbitrage opportunity, credit market arbitrage, creating something out of nothing, turning lead into gold and brandishing securities, distributing securities across the world that were supported by assets of extremely shady quality, but yet had phenomenally high credit ratings. So at the end of the day, Wall Street is responsible for the damage. It profited from this, and we're all there picking up the pieces.
Okay, Bill Isaac, I understand you can hear me again, so let's try it. If you had to put the preponderance of blame on one or the other, Wall Street or government policy, which would it be for you?
I would blame the government because I think this entire crisis was entirely avoidable. I think we've had very bad policies in place for the past 20 years that led to this crisis. And the analogy I would make is that I really believe that greed is a force of nature. It really makes the capitalistic system operate. And obviously, I'm not trying to condone excessive greed, but that is what makes the system work. People want to do better. They want to make more money. They want to provide more for their families and the like. And it's a force of nature similar to gravity. And it's up to the government to make sure that greed does not get out of control, just as it's up to the government to make sure that planes are maintained safely and they fly the proper routes and they have all the service they need at the appropriate times and are operated by skilled people. And the same thing is true in our financial system. If the government does not regulate the planes properly, the gravity's going to take over and they're going to fall to the ground and kill people. And if our financial system is not regulated properly, it too is going to get out of control. It's going to cause a lot of damage, and that's happened here. But I think Wall Street or the bankers did what they do. And it's really important that we have the right policies in place, the right regulations in place to stop things from getting out of hand, and we didn't do that.
Okay,
and we didn't have good monetary policy either.
With the two who said Wall Street was more to blame than government policy was to blame, that's Yves and Louis. I want to follow up with you two on this question then. Successive U.S. presidencies, and I'm thinking Bush 41 and Bill Clinton and Bush 43, made it progressively easier and easier to get loans, and in fact quotas were set for loans to people with poor credit ratings or poor credit history. So in that case, Yves, can you really set the preponderance of blame on Wall Street when those kinds of conditions were created by government and in some respects forced down the throats of places like Fannie and Freddie?
If you look at the data, Fannie and Freddie had a relatively small role in the subprime crisis. In fact, Fannie and Freddie were substantially out of the market from 2002 to 2005 as a result of their accounting scandals. So while they played a role, their role in the subprime crisis was actually not as large as a lot of critics would like to claim.
Okay, how about Louis, you on that one as well?
Well, it actually goes back further than that. It goes back to the 1977 when Jimmy Carter signed into law the Community Reinvestment Act. This was an incredible piece of legislature that became, an intrusion into the world of banking, ultimately forcing banks or encouraging banks to lend to people who have absolutely no assets and no revenues and nothing. So we've seen a wave of deregulation that has unfolded over the past 30 years. And a wave of misregulation at the same time. Wall Street has demanded many of the reforms that have taken place. Let's not forget that Glass-Steagall was repealed some time ago, and that set the stage for more Wall Street tricks. And at the end of the day, the economic doctrine of the day prior to this big credit market meltdown was that financial institutions had an incredibly deep sense of their own survival, and that they didn't need to be regulated anymore. They were too sophisticated. They knew how to do this too well, and therefore we could let them do what they want to do.
Okay, Tim, let me follow up with you as the former big bank chief economist here. Tell us what effect those government policies, and I know you're one of the people on this program today who said it was in fact more government policy than Wall Street malfeasance that got us into the pickle we're in. What effect did government policy have on investment bank behavior?
Well, it certainly, the deregulation made it possible for investment banks to get larger, to get involved in a wider range of activities than they had hitherto. But let's be careful here. We have countries like Canada, Australia, and so on, with highly concentrated banking systems went through exactly the same deregulation as occurred in the U.S. and have escaped virtually unscathed this whole financial crisis. So we have to be a little bit careful about how much we attribute to the banking systems, as it were, and the consequences of deregulation. There certainly, over the last 30 or 40 years, we've had a considerable amount of innovation in the creation of financial products, and the fact that they may be complex doesn't make them perforce evil. What it suggests is that we need to understand them better and make the process of their creation and their sale more transparent. But I think well, I was going to say it borders on absurdity to think that what we ought to do is turn back the clock to simpler days of the 1970s or 60s. We have a more complex world. We have more complex arrangements financially. I think government policy certainly helped create an environment where a problem could emerge. But I don't think that deregulation per se was the cause of the financial crisis.
Okay, Yves, you want to follow on that?
One development, deregulation, that had substantial impact on the crisis was actually in the hands of the industry itself. The New York Stock Exchange, a self-regulating organization, dropped the requirement that investment banks be partnerships in 1970. You didn't see firms blowing themselves up en masse when they were private partnerships because the partners would lose not just all their investment in the firm, they could lose everything they had. And it turns out, with the benefit of hindsight, that check was vitally important, that when the managers were playing entirely with other people's monies, that was a massive change in incentives.
Well, let me follow Bill on that. Did the investment banks need much encouragement from government to create the highly lucrative and highly complicated, and as we've discovered, highly risky investment vehicles that they did?
No, I mean, the investment banks were pushing the government. For example, in 2004, the SEC greatly liberalized the capital rules on the investment banking firms and their parent holding companies and allowed them to balloon their balance sheets, increasing them, leverage 3 or 4 times more than they had in the past. And in addition, the Financial Accounting Standards Board, again in response to industry pressures, allowed for securitizations to be taken off balance sheet and out of capital requirements for banks. That added trillions of dollars of risk to the system at the height of the boom and helped way overheat the economy and the housing markets, and the consequence was the collapse in 2008. I would also add that we can talk about this a little bit later, maybe in more detail, but I would want to get out there the thought that this crisis was, my book is entitled Senseless Panic for a reason. I don't believe that this crisis should ever have become a panic. I believe the crisis itself was terribly mishandled by the U.S. government and was allowed to get out of control to the point where a worldwide panic was created.
Okay, before we go there, though, before we go there, let me just follow up with Louis on that aspect that you brought up, which is, Louis, if I'm reading you correctly, it sounds like you're saying Wall Street didn't need a heck of a lot of nudging by government to behave badly to begin with. Is that right?
Well, put it this way, Wall Street is an extremely innovative place, and the impetus to generate money-making businesses is extremely high. So, if we allow Wall Street to operate with very, very poor supervision and guidance, and an extremely loose regulatory framework, ridden with loopholes and regulatory arbitrage opportunities, of course Wall Street is going to move right in. And derivative instruments, derivative securities are such powerful tools that they can enable you to do anything you want at the end of the day. So I think that the environment, the conditions were set such that Wall Street had an opening to make an awful lot of money very, very quickly.
Okay, let's look at the other side of things for a second. Then we've put the accent on Wall Street. Now let's take a look at government. And to that end, I'm sure there wasn't anybody on this program today who missed what Barack Obama had to say and to whom he said it and where he said it just a little over a week ago when he had this to say about Wall Street reform. Here's a clip. Roll tape, please.
As I said on this stage 2 years ago, I believe in the power of the free market. I believe in a strong financial sector that helps people to raise capital and get loans and invest their savings. That's part of what has made America what it is. But a free market was never meant to be a free license to take whatever you can get, however you can get it.
Okay, there's that speech. There have been the hearings in Congress over the past couple of weeks where the message has been really clear from the politicians. We, chest-thumping politicians, are holding you contemptuous Wall Street so-and-sos, to account. And here's my cheeky little question, and okay, Yves, you take this one on first. Are the right people in the dock at the moment?
Only some of the right people are in the dock. There's been a fixation on Goldman Sachs, which is deserved. There are a lot of other firms that were quite responsible as well. I mean, for example, you alluded earlier to the rating agencies. There's been intermittent focus on what to do about them. They still enjoy substantial legal protection in terms of a first. They claim that their ratings are mere journalistic opinion, and that's been upheld in court. So they've so far gotten off relatively unharmed by this. There are a lot of other banks besides Goldman that were engaged in practices that are questionable. Presumably that's going to come to light as the scrutiny's been turned up.
Tim O'Neill, were you a little bit offended to see the politicians playing holier than thou with all of those Wall Street executives in the dock?
I'm almost invariably offended by self-righteous politicians uttering bombast rather than logic. Look, the first point is these companies were creating products that people wanted to buy. And most of those people who wanted to buy them were very sophisticated investors. I mean, the organizations that are involved, for example, in the Goldman Sachs incident, whatever may be the final truth about how much a role Paulson played in actually creating the what occurred, the fact of the matter is you had very sophisticated firms that were involved. These were not run-of-the-mill or standard residential or retail investors. You've got pension funds, you've got very sophisticated international companies who need derivatives, who need hedging products, and Wall Street and other financial institutions outside of the U.S., let's be careful, let's be clear here, we're perfectly willing to create and sell those products. So to focus on a few Wall Street firms, I think, is to miss the point that what we're looking at is a process of innovation that was global in nature, that involved firms from large financial institutions from a number of countries, many of whom have not run into the kind of difficulties that we've seen in the U.S. So I think we're, in some respects, and the politicians in particular, are focused on the wrong issues. And the consequence of that almost invariably be that they'll get the wrong policy measures designed.
Yves, you want a quick comeback on that?
Yeah, I mean, I've actually done a substantial amount of study of the collateralized debt obligation market, and my book Econ actually broke the story on Magnetar, which was a very important player in that market. There's a bit of an urban legend about the collateralized debt obligation market, in that the demand for that product actually was substantially members of the financial community themselves. A lot of that paper, tremendous amount of the AAA paper, was actually wound up with the banks themselves because they could get very favorable bonus treatment for the dealers themselves. Another substantial source was correlation traders. Again, either hedge funds or the bank's own proprietary trading desk. So a lot of this paper was effectively a Ponzi scheme within the industry itself. That story has not come out to the degree it needs to yet.
Bill Isaac, I don't know how much of those hearings from Congress you watched last week, but as you watched the politicians pointing their fingers and going, j'accuse, what went through your mind?
I try not to watch any more of it than I have to because I'm so offended by it. I think Tim had it spot on. The politicians, they're in an election season right now. They adopted that TARP legislation, putting $700 billion of taxpayer money at risk. I was strongly opposed to the TARP legislation. We actually defeated it in the House on the first vote. But now the public is outraged that they had to put up all that money to bail out the banks when it was really quite unnecessary. And the politicians have an election coming up, and so they're trying to blame the banks for all that went wrong. In fact, Washington's policies and mishandling of the crisis got us here, and they're saying that, well, it's the big banks, it's Wall Street, and we're going to end too big to fail. And this legislation will do nothing to end too big to fail. They aren't reforming our broken regulatory system, our highly dysfunctional regulatory system at all in this legislation. And they're not taking on a number of reforms they ought to be making. This bill, in my opinion, I wish it wouldn't pass. It probably is going to pass, but
well, Bill,
I wish
let me
it
just
wouldn't,
jump in
so
for a
that
second and do a follow-up with you on
Sure.
this one, because you said election year politics kind of influenced a lot of this. But you know, if memory serves, the TARP was put together by Bush 43 and Henry Paulson, neither of whom were looking for re-election. So do you want to revisit that?
Well, I'm saying the people who are putting together this legislation right now are playing to the crowd because the taxpayers are very upset about the TARP legislation, which I believe was a horrible mistake. Said so at the time. I think it did much more harm than good. And so now they have to try to placate the taxpayers who are very upset. So they're saying, well, we're going to get those banks and we're going to end too big to fail once and for all. And that's just not happening. We need to do, I think that we need to, if I were in charge, we wouldn't be doing any reform legislation until after the election so we could all have an intelligent conversation about what really caused this crisis and how we ought to go about fixing it. Because this legislation is not going to fix the problem. Okay. If this legislation were in place, we would have still had the crisis and we will still have the next crisis even if they do pass this bill. We're not fixing it. And I think it's time to have a serious conversation that this country is not going to have in an election season.
Okay, Louis Gagnon, in spite of what Bill just said, it does seem pretty clear that some kind of regulation is coming to Wall Street. Not sure how deep or how broad it will be yet, but something's going to happen. And if, as we seem to have established here today, politicians are just as guilty, we don't want to say more or less, but just as guilty as bankers in the creation of this fiscal mess, how do you think they're going to be held to account?
Well, it remains to be seen. I mean, I think the U.S. public is extremely dissatisfied and disillusioned with the system, and rightly so. Millions of people have lost their jobs. The economy went down. We've been talking about a great recession. I mean, this is not small potatoes. This is a huge crisis, and there's no precedent in history before the Great Depression. So clearly, something's going to happen. There's a Tea Party in the United States now that is making an awful lot of noise. There's no question that politicians, should share an immense amount of blame here. But at the end of the day, they created the circumstances. They created the legal environment at the under pressure from Wall Street and all the people who ended up raking in the profits from this huge activity. And so it's tough for them to be holier than thou at this point, because these are the laws that they put in place originally and the changes in regulation that they put in place originally that allowed Wall Street to get ahead of itself.
Okay, Tim O'Neill, let's talk a bit about the calendar here, because the financial turmoil started, I guess, in 2007. The crisis really hit in earnest just around the time of the Canadian election, which was around September, October 2008. We are now coming up to halfway through 2010. Why has it taken so long for any kind of significant push for regulation to take place?
Well, it's pretty hard to figure out how to smooth the waters when they're still roiling. So you're talking about a protracted process of trying to figure out what the degree of problem was, and then dealing with the aftermath, two aftermaths. One, of course, to which Bill has already referred, which is how do you deal with the problems of a potential systemic failure in the banking system, and then two, how do you deal with the economic fallout from all of this, which is a serious recession. It's worth noting parenthetically that the decline in economic activity in the U.S. is actually no worse than several recessions we've seen since 1945. But the fact of the matter is, if this were really simple stuff to figure out, we would have done it a long time ago. We wouldn't have had the crisis in the first place. Financial regulation is complex. Financial services are at the sort of core of economic activity. They're the they're the blood, the system, the heart of the economy. And so in that case, you got to be really careful about precisely how you make the changes. The one law that politicians almost invariably ignore, to all of our regret, is the law of unintended consequences. So you have to be fairly careful about how you roll out, for example, too big to fail policy. I think Bill is absolutely right. What is currently on offer is probably not going to resolve that. If anything, it may make the risk of a future crisis based upon excessive risk-taking even greater than not changing the law at all, changing the regulations at all. So it takes time to figure out what caused the problem and how you resolve it going forward.
Okay, let me get Yves Smith on that then. Yves, do you accept that explanation that these things are complicated, the waters were choppy, you got to wait a bit before you wade in there to fix things?
Well, it's, on the one hand, that's true, and I've said repeatedly that we haven't had anywhere near the forensics done that should have been done. I mean, for instance, when UBS, the Swiss bank, got in trouble and needed a bailout, the Swiss banking authorities demanded that it produce a report explaining how it got itself in so much trouble. Why haven't all the banks in the US and in Europe been made to produce those kind of reports? That would provide you a lot of information just as a starting point to understand what happened. The flip side is that the industry has repeatedly used the excuse, oh, we can't do anything now because things are, the crisis is still in motion. And then after crises occur, they've gone into, oh, there's no crisis anymore, see, everything is fine, therefore you don't need to do anything. One of the big examples of that was in 1994 when there were a series of derivative meltdowns that resulted in losses that were bigger than the 1987 crash. The industry managed to fight off legislation with the same strategy. First, if there's a crisis, we can't do anything. Then, everything's fine now, you don't need to do anything.
Let me read from everybody's favorite New York Times economist these days, it seems, Paul Krugman. Here's what he had to write in the New York Times a week ago, and then, Bill, I'll put a question to you first coming out of this. Reform actually should hurt the bankers. A growing body of analysis suggests that an oversized financial industry is hurting the broader economy. Shrinking that oversized industry won't make Wall Street happy, but what's bad for Wall Street would be good for America. Now, the reforms currently on the table, which I support, he's against you, Bill, might end up being good for the financial industry as well as for the rest of us. But that's because they only deal with part of the problem. They would make finance safer, but they might not make it smaller. But the fact is that we've been devoting far too large a share of our wealth, far too much of the nation's talent, to the business of devising and peddling complex financial schemes that have a tendency to blow up the economy. Ending this state of affairs will hurt the financial industry. So? Okay, Bill, do you agree with Krugman that the financial sector is, by its sheer size and activities, in fact hurting America?
I don't agree with much that Paul Krugman says, and I certainly don't agree with him that the legislation that's on the Hill right now, the Dodd bill, for example, is going to do anything to fix our system and prevent the next crisis. We must reform a badly dysfunctional regulatory system. And until we do, we are going to go. That system we have, regulatory system we have, has produced 3 major banking crises in the last 40 years: the real estate collapse in 1972 to 74, the collapse in virtually every field, whether it was energy or third world debt or real estate or the agricultural sector and the thrift industry. From 1980 to about 1991, a massive set of problems that far exceed anything we're experiencing today. And now today, the 2007 to 2009 crisis, 3 major financial meltdowns in 40 years, and we're not fixing the system. We still have way too many regulators dividing up responsibility for this system. We don't have the accounting system under control. We have all sorts of highly pro-cyclical regulations in place that need to be fixed. And unlike Tim, I would go back and revisit whether we need to put some form of Glass-Steagall back in place. We have enormous concentration in our financial system. Our 5 largest institutions control over 50% of the assets in the banking system. I don't think that's healthy. And until we fix those problems, we will always have too big to fail, because those institutions, those largest institutions, never get in trouble alone. They're too big, they're too diverse for that. They get in trouble when there is generally widespread problem, there's a bubble, whatever it is in the economy as a whole, and they get in trouble together. And when they're all in trouble, you can't let them fail. You're stuck with them. And you've got to, and even if the Congress this time around did something as plain as the government may never do anything to help any financial institution that's in trouble, period. If they did something that clear, which they're not, there will be, the next time these banks get in trouble, there will be a new Henry Paulson, and he will run up to the hill, and he will ask to demand taxpayer money, and he will get it, and we will bail him out.
Okay, well, as
What
long
we've
as
got
we're
to do
asking
is fix the system that brings us that.
As long as we're asking the political question here, Louis, let me put this to you. Given the ties that this administration and frankly all administrations have with Wall Street, can you imagine that this Congress, and eventually obviously to be signed by the President, will put something through that will handcuff the financial system in the way that Paul Krugman described in his piece there, which he believes would be good for America?
I would be extremely surprised if Washington were able to put together a piece of legislation that will resolve the problem. I think we understand, by the way, exactly why we have this problem. We understand which markets created this problem, and we have a fairly good, fairly high amount of resolution on all this. But at the end of the day, you need political will to make changes. And I don't think that Washington, D.C. has the political will. Washington, D.C. has been heavily influenced by Wall Street for decades, in fact, forever. And at the end of the day, it'll be a real surprise to see Washington actually fixing this problem. And I agree that the legislation that we have on the table right now is not going to go is not going to solve the problem. I mean, we're still debating in the United States the difference between derivative securities, which are wonderful instruments that create immense value, and cash market securities. We have the CFTC, Commodity Futures Trading Commission, that governs these activities. And then we have the Securities and Exchange Commission that governs the cash market, the equities market, the debt market, etc. This is absolutely unworkable. You have to clean up the regulatory system in the United States. It's far too complicated. It's full of holes. And you have to simplify things in order to make them better. And you also have to bring all the shadow banks, all these special purpose vehicles, bring them into the light. These highly risky activities were undertaken outside of the radar screen. We all knew that this was taking place. We saw the credit derivative marketplace, shooting up to $65 trillion in notional amounts. We all saw that, and we all were scratching our heads. There's no question that games were played. There's no question that we could quite easily address these problems. Put light, put all these things under a very, under the sunlight, and you'll see the activities melt.
Well, they do say that light is the best disinfectant for all kinds of corruption.
Absolutely. I mean, we have to be serious. We can send people to the moon. We can send probes to Mars, and you are now telling me that we can't fix the financial system that we set up together? What is this?
Okay,
it's
Tim,
not that complicated.
Let me try this with Tim. You know, obviously in an election year, politicians are anxious to be seen to be doing something to deal with this. The question is rushed reform, and we can discuss whether or not this is in fact rushed reform, but if it is it worse than no reform at all?
It may be. It depends on the details of what comes out at the other end. If the policies that are designed to retrospectively punish banks, then almost certainly it won't do anything to resolve future possible problems. If instead the focus is on how we best regulate going forward, then there's a chance that they might get it right. But the fact that they're in an election year, that banks are highly unpopular, that the level of pay that bank executives get is highly unpopular, causes politicians to play to the emotional issues rather than to the factual issues. I think I may not agree precisely with what Louis has said, but the fact is that transparency is ultimately one of the most important policy adjustments that can be made here. Whether that's in contractual arrangements that banks and other institutions have with retail customers, or it is in the visibility of what is in complex products, or its visibility of the off-balance sheet activities of banks, this is really central, I think, to creating a more effective policy environment in the U.S. The other thing I'll note is we have focused so much on the U.S. that we forget that there are other countries that seem to have done reasonably well. And one I'll throw in for people to consider here is, if you look at the Canadian system of regulation, it's not dramatically different in architecture or process from the U.S. One key difference, however, is that in Canada, regulation is done on the basis of principle or intent rather than on rules. And I think one of the things that has hurt the U.S. is an excessive focus on rules, which it pays institutions, whether they're financial institutions or auto companies or anybody else, to find ways around, to hire clever people to figure out how to evade legally the restrictions that are put in place. I think that fundamental change in sort of conceptual framework for financial services legislation in the U.S. Might be a critical change that would be very useful.
Gotcha. Yves Smith, you wanted to follow up?
I think that's going to be, I wanted to address the remarks in sort of reverse order. I think it's going to be very difficult to go to a principles-based system in the U.S. because we have a rules-based legal system. So imposing a different regulatory, trying to impose different regulatory notions that and then that ultimately could be fought in court, you're going to have a bit of an outtrade there. But I think the bigger point here is that I'm cynical about the whole approach of this reform bill. I mean, I'm as jaundiced as the other speakers are about it, but I personally think that it was never intended to be serious reform. Obama brought in people who had substantial ties to the financial services industry, were architects of the policies that caused the crisis to begin with. Do you think, that crowd has in fact, I was speaking with Martin Wolf last night, the Financial Times' chief economics reporter. And he said if you wanted to pick a team that could do a better job of patching together the old system and making it look like it would work, Obama couldn't have found more suitable people for that role. So this very same team has been sort of the intellectual forces behind the so-called reform bill that's been moving through Congress, which is inadequate at best and is being touted as reform because the public wants to see reform. The worst part of this isn't, in my mind, that it's rushed. It's that once having done Potemkin reform, there's going to be no will to do more.
Here's how the Daily Beast portrayed this last week, this by a professor of business at NYU, Tunku Varadarajan. There is no doubt, he wrote, that Obama is tapping here into a rich seam of public discontent. The view that Wall Street has wrought havoc on our economy is held by many more Americans than not, and so any assertion by the president that something must be done is likely to meet with popular and populist approval. A fear and loathing of big business is evident among ordinary Americans on both the left and the right. You can see it at gatherings of Tea Partiers as much as on university campuses. Bill Isaac, has he got that right?
No, I think he has it right, and I want to applaud what Yves just said, because I'm absolutely convinced that if we pass this legislation in anywhere close to its present form, it will do no good in preventing the next crisis, and what it will do is shut down the debate on more serious reform. Once we get past this bill, if they pass it, we're done. We're not going to have any more reform until 10 or 15 years from now, when we have another very serious crisis and we have to bail out a bunch of banks again and put taxpayers at risk again, and then we'll go through another debate with probably the same results. So the real harm in passing this legislation is it will shut down debate. Right now, the public is clamoring for reform, and if we give them this reform, which is meaningless, or virtually meaningless, I don't want to overstate the case, there are some good things in it, but it's virtually meaningless. If we give them this reform, we're done. We're going to move on to Social Security or whatever else we move on to, and we will have lost the attention span of the public, the media, and the like, and we will not have real reform ever.
Well, it would be unusual for them to miss this opportunity because, of course, Rahm Emanuel, the chief of staff to the president, had that well-known comment of, you can never let a good crisis go to waste. Louis Gagnon, does it make sense in your mind that the White House would miss this opportunity to put in place an historic, proper set of reforms in order to get things back on track?
It would, I would not be surprised, because politicians are politicians and they lack will and they lack the backbone to institute changes. But I would be extremely disappointed. I think that we have to keep in mind that this crisis, this credit market meltdown that turned into a global recession, has cost millions of jobs, has destroyed lives, has caused people to lose their homes. This is as serious as it could get. So here's a phenomenal opportunity for a politician and his team to put their imprint on the system and try to make changes that will set us on the right course. It would be an incredible precedent. It's never happened before. And I think that if the president can do that, he'll be able to walk on water. However, seeing what we see in Washington, D.C., the two pieces of legislation that are being debated now in the Senate, I'm not going to hold my breath.
Well, you know, of course, the newspapers are kind of nasty in Washington, and if you were able to walk on water, they'd probably, the headline in the Post would be, you know, Obama can't swim, something like that. But in any event, let's check this out. We got about 10 minutes to go here, and I think we still want to get some deeper sense of how much power Wall Street still has in Washington. Wall Street, it seems, across the country, their stock, no pun intended, is pretty low right now. But Tim O'Neill, why don't you start, or forgive me, let me go to Yves Smith first, because you're right there in New York City. How much power do you think Wall Street still has in the corridors of power in Washington?
Oh, I think they've got a tremendous amount of power. I mean, we do see, you know, things like Goldman Sachs is now apparently a pariah. Their lobbyists are being ignored. But at least on a current basis, but we have the immediate reasons that Wall Street has power and the bigger ones. I mean, the immediate one is the obvious, that they give a tremendous amount of money to campaign contributions. And with televised advertising being so important to winning campaigns in the U.S., follow the money. Whoever gives a lot of money is going to have an influence on the process. However, the bigger reason, which I don't think gets the attention it deserves, is that the industry understands something that basically they hold the gun to the economy's head. We've had a policy over the last 20 years of shifting activity from bank balance sheets into trading markets. So you now have what Timothy Geithner once called market-based credit. For example, loans in the U.S. are now substantially securitized. The result is that you have got a relatively small number of firms around the world. You know, different people count it differently, but let's say 15 to 20 firms that are critical to these global debt trading markets. They control infrastructure that is critical to the global economy, and nobody's going to mess with them very much. That's the bottom line.
Tim O'Neill, would you agree with that analogy that in some respects Wall Street is still holding a gun to the economy's head and therefore their clout in Washington is still very, very high?
I might describe it differently, but the fact is if your financial system in every country is what provides credit, what provides liquidity for the operations of business and households, then of course their power in the economy is significant. That's different than suggesting that they can have whatever they want out of politicians or out of a political system, whether it's the US or Europe or Canada or the UK or anywhere. The fact of the matter is they have to compete with other influences on public policy, and in particular they have to deal with the fact that banks naturally are very unpopular in virtually every country, and in the midst of populist outrage and a midterm election fever that will heat up over the next few months, the chances, I think, are better that politicians will actually get something done. Whether the something they'll get done will work or not and will be right or not is a wholly different matter.
Mm-hmm. Bill Isaac, remind me, when were you the chair of the Federal Deposit Insurance Corporation?
I was there from 1978 through the end of '85, about 8 years. And I would just tell your listeners that that was a much worse period than this one, apart from the fact that we had a panic in this period we didn't have back then. We had 3,000 bank and thrift failures back then, including a lot of very big banks, 9 of the 10 largest banks in Texas, for example. So it was a very tough period, and we got through it without creating...
Tell me this, though. I want to get since you were there then, I want to get an understanding of the kind of, and I presume you had to deal with big banks all the time. What kind of, as you measured the clout that Wall Street had in Washington at that time compared to the way it is today, how would you compare it?
A lot less back then than it has today.
So even with Wall Street stock as low as it is, it's still got way more schlep today than it did back then, you're saying?
Well, I think so, and the financial system is far more concentrated now than it was back then, which makes these firms even more powerful politically. But not that they were without power back then in the 1980s, but I think they have considerably more power today, which is one thing that troubles me about a highly concentrated financial system.
Louis Gagnon, how troublesome is that if Wall Street, in fact, has that much more power today than it did 25 years ago?
Well, this simply means that the chances that we'll be able to implement meaningful reforms are that much lower. Wall Street's influence over the economy, as you were stating earlier, has increased immensely in the past 25 years. You just examine the share of GDP that is captured by the financial system. It's incredible now. With the share of GDP and the fact, as Tim mentions, that the banks basically sit on the backbone of the economy because the credit marketplace constitute the backbone of the entire economic system, makes it extremely difficult to argue with them. And however, banks don't have to be demonized. It's not the tools they've been using, it's the manner in which they've been allowed to use them. We can fix all that. We can restore banks. We can restore this system. There's no question that meaningful reforms can be implemented.
Well, when you say we, let me follow up on the we with Yves Smith here, because I want to know who the we is in the room. And by that I mean, do you think there are representatives of the investment banks that are actually in the halls of Congress, in the offices, with the representatives and the senators helping to write these bills that they're debating right now? Is that happening?
There are lobbyists that are involved in writing the bills, not the investment bankers directly. In fact, that was also the case with the health care reform legislation. A lot of the language basically does come from Wall Street. Then you get to the question of intent, whether their intent is to promote real reform, and I can't believe that it is at this juncture. I mean, one of the things that Simon Johnson, the former chief economist of the IMF, has written about is that we now have basically, that the situation in the U.S., he argues, is very much like that of countries that the IMF have run into when powerful oligarchs have an inordinate amount of power. And he says that the only way that you see real reform is that when some of the oligarchs decide to break and go with reform, that they decide that basically that the cost of doing things the old way is too high.
You seeing any evidence of that this time?
I don't see any evidence that that's happening yet. It might happen, but I don't see any evidence, none, that this has happened now. The industry is all singing from the same page.
Tim O'Neill, let me get you on that issue of whether or not the people who are supposed to be regulated are actually in there writing the regulations. Presumably they've been consulted at some point because it all is going to affect them. But would it be appropriate for them to be in the room helping to write the bill?
Well, I think, as Yves has said, they're not in the room. The lobbyists are trying to influence what's written. But I think the point is that they are not the only. Even if they had been in the room, they are far from the only people that are there. There are a lot of very clever people whose advice is being sought on this, who take a very different perspective. There are the Louis Gagnon types and the Bill Isaac types who will be trying to have an influence on whatever policy is finally written. Bill referred to the fact that he was helpful in ensuring that the first version of TARP was actually defeated. Those kinds of people, I don't know who those two individuals are, but there are people like that whose advice will be sought, who will be very much used in the writing of any legislation, whatever form it takes. And unfortunately, I think even people like Krugman will have their advice sought, even though I don't think much of his views.
But do you read them anyway in the New York Times?
Oh, of course, everybody reads them.
Okay, just checking. Let's, in our last few minutes here, then finish where we started. Who does, Bill Isaac, in your view, need more reform, Washington or Wall Street?
Both, clearly, but Washington by far needs more reform than Wall Street. If we reform Washington, Washington will reform Wall Street. If we don't reform Washington, Wall Street will go on with business as usual, leading us to the next crisis. That's my view.
And reforming Washington, in your view, would involve, briefly, what?
Well, Senator Dodd was on the right track last November when he proposed to take the regulatory functions that are now spread around Treasury and the Fed and other agencies and consolidate them into a financial institutions regulatory authority, which would be an independent agency, not subject to monetary policy considerations, not subject to the politicization that the Treasury brings to it. An independent agency to regulate these institutions with two watchdogs on it, the FDIC and a truly independent systemic risk council. Dodd has, in this current bill, has a systemic risk council that is run by the Treasury and the Fed and all the agencies that it's supposed to be overseeing. It's a farce. It's not reform at all.
Louis Gagnon,
so
who needs more reform?
That's what really needs to be done.
Okay. Washington or Wall Street, Louis Gagnon, who needs more reform?
I tend to agree with Bill. We have to reform Washington, because Washington is now responsible for putting into place smart rules, not necessarily more rules, but smart rules, and to level the playing field and bring light on all these activities that have been undertaken under the radar screen. I think that this is where the solution has to come from, because Wall Street has actually engineered, not to demonize Wall Street, has actually engineered the sort of the self-regulatory doctrine that has taken hold in the United States, and that has led to where we are now.
Okay, let me make sure I save time for Tim O'Neill and for Yves Smith on this. Tim, you first. Washington or Wall Street, who needs it more?
I think clearly Washington, whether you demonize the banks or not, and however much blame you assign to them, the fact of the matter is, if you don't like the behavior, you've got a set of framework and a set of principles / rules that will create a different kind of behavior. You can't prevent stupidity, but at least you can corral it. And you can prevent it from being systemically problematic.
Yves Smith, you get the last 30 seconds.
I still believe that Wall Street bears substantial culpability for this. I agree with the other speakers that reform is therefore going to have to come externally, because the industry can't generate it on itself. But I worked in the industry in the 1980s. The attitude, the culture was really quite different. Even though people were greedy, they weren't short-sighted and destructive towards their own firms and the kind of behavior that they engaged in. It's completely different now. I mean, significant producers really are willing to do things in a very short-sighted way that hurts the business, and they don't care as long as they get their bonus.
I want to thank all four of you for joining us for a really great discussion tonight on one of the most important financial issues of our time, or any time for that matter. Bill Isaac, the former chairman of the FDIC, author of Senseless Panic. Yves Smith, the author of E-Conned, and also the Naked Capitalism blog, in our studios in Sarasota and New York, respectively. And up here in Canada, Tim O'Neill, the former chief economist, the BMO O'Neill Strategic Economics, now in Halifax, and Louis Gagnon from the Queen's School of Business in Kingston. Thanks so much, everybody, very much.
Thank you.